Now let's take a look at Genmab. This is a company that I'm very interested in. I had some analysis done on this by myself. Let's look at it. So currently it sits at 27.5. If we get some cash out of Google, this could be a great place to store my cash. Now, it ticks every box of our own algorithm. This algorithm looks at every great value investor, Warren Buffett, Charlie Munger, Peter Lynch, Benjamin Graham. It looks at how they bought their stock, how they decided whether they wanted to invest in something or not, what qualities they wanted to see in a business, and whether or not these qualities are met. Financial Fortress looks at liquidity, it looks at operational margins, it looks at R&D margins in relation to revenue, it looks at SG&A expenses in relation to revenue. It analyzes the entire balance sheet from the last 5 to 10 years, depending on how old the business is and how many years it can be analyzed. And it says whether or not, based on the perspective of these great investors, whether or not this company can be seen as a financial fortress. The compounding engine looks at the growth rate of the business, completely separated from the price. So it looks at, okay, based on their revenue growth, their free cash flow growth, their operational efficiency, can they compound on themselves? And as an investor, you want to use compounding your advantage. It's the last great wonder of the world. And this is where you can make significant amounts of cash. Once again, through the lens of all the great investors. And the last thing is entry price. It looks at, okay, given this business, given this price that you're currently paying for it, is this a good price to buy it? Yes or no? Yes or no? And again, through the lens of these great investors. And for this business, all three of these are a check. That's and what does this tell you? If you get three checks, three green signals saying this is a great business, it doesn't mean go out and buy it straight away. It means this is a business to take a look at. We have a stock screener where you can filter on all of these and see if there are businesses that match all three of them. There is never a lot of businesses around that pass all three of these checks, but if you see a business, it's absolutely worth your time to take a look at it yourself. Again, we're here to teach you the process of how to look at a stock. We teach you here how to put your money to work, but it's up to you to do the hard work, and you still have to do the due diligence on this business. You can use our software and you can join our community to make sure this happens, but it's still up to you. Never buy something because somebody on the internet says to buy something. Never buy something because I own it or I'm interested in it. Do your own due diligence, do your own work, and that's where you will make your money and secure your financial future. Now, once again, for this business, 3 question marks. Is it a great business? Can we buy it at a great price? And can we reliably predict it for the future? Great business, given the checks, I'm already leaning towards it could be a great business. So again, what are we looking for? Let's start out what we've been starting out with all day today is their cash position, which is 21,000 in relation to their short-term debt. Short-term debt is 0. Perfect, absolutely perfect. Let's look at their cash flow. Let's increase the periods. We want to see growth and we want to see stability. It has grown. There is a little bit of a decrease here. We see growth, a little bit of instability, but overall we see growth. We don't see any negative numbers, so it's never too bad. But it's not the most stable, but there is absolutely growth. So this is okay. This is okay. Let's look at the revenue. They've managed to increase their revenue year over year over year, except for 2020 to 2021. But they made up for that 2022. Then they continued that growth trajectory. This is looking very well. Now, we've looked at the balance sheet before. Any of you probably know what this business does. And I like to do it like this, but not everybody wants to do it like this. And the reason for that is I first want to make sure, okay, could this be a great business before I get dragged down in the story? It's very easy for a good story to become a bad investment. And therefore, I want to look at the fundamentals and then take a look at what the business does. Now, Genmab, they make innovative cancer treatments, absolutely cutting edge. They have epcoritamab is for lung cancer, and Rina-S is for um, for ovarian cancer. And they have 6 other already revenue generating treatments out there. And their business model is focused on developing and commercializing antibody therapies. And they earn money through product sales and partnerships. So this is a biopharmaceutical business. Therefore, they are reliant on revenue streams from their already successfully trialed and FDA approved medication to be sold. And they're also very dependent on their R&D cycle for new medication to be approved for them to generate revenue over. Now, they have a strong edge with an advanced pipeline. They still have some approvals to go through, but most of them are in phase 3, which is at the end of the cycle. And they've shown the ability to deliver effective medication. They have 3 billion in cash. Great. Indeed, it provides flexibility to navigate challenges and invest in growth. Great. Now, research is historically proven to be very, very, very cash intensive, and they have the cash to back it up and to actually get things approved. They also have the cash flow to generate more cash and to keep growing both their R&D line, so they're positioned already very well for the future, and they are on a solid growth trajectory. They reported a 90% revenue increase and a 56% operating profit growth in the first half of 2025. Ooh, perfect, perfect, perfect. They focus on late-stage programs, Rina-S and Genmab. Suggest they're prioritizing high-potential products to drive future revenue. Mention optimistic about upcoming regulatory decisions. Target action date November 30, 2025. That's not too far away. Most of the time, if these are successful, you see the stock take a little flight. They plan to initiate 3 phase 3 trials for Rina-S by year end, indicating commitment to advancing their pipeline. They have a robust cash position of 3 billion. Recent product approvals and ongoing trials suggest strong future revenue growth potential. Management's focus on late-stage programs indicates a disciplined approach to development. Okay, I'm getting a good vibe, good feel from this. If you look at the revenue growth, again, positive. And the change from the last few companies we looked at, the 5-year average is already positive, but last year's average is even more positive. So they managed to increase their growth trajectory. Free cash flow side, this is not entirely the case. We see some ups and downs, but overall, an increase. Return on invested capital is very high. It's in the 20s. That's what we like to see. Their cash to debt is absolutely bonkers. Usually, you want to see cash to debt numbers that are a lot lower than this, but because biopharmaceutical companies are very, very cash intensive, and you see that their cash levels are already decreasing quite significantly in the last few years, probably due to their phase 3 trials. And I already did some more research on this business. They've recently acquired another company that's very interested or very interesting for their entire portfolio. I'm not entirely sure what the name of this business is, but what the business does is they create targeted cancer medication, very highly targeted cancer medication. Instead of the old treatment paths that used to nuke the entire body and hope the patient survives longer than the cancer, this business allows them to create medication that can be very, very personalized for the patient and highly personalized for the cancer that the patient is experiencing to deliver treatment that attacks only the cancer. This is a huge improvement to both the patient patient empowerment and the way the patient receives their treatment. It's a lot less destructive than the old treatment paths. There are other medications that already try to do this as well. We've already advanced in the medical field quite a bit, but they can add this to their own product portfolio, and they can build on this quite a lot more. And they have the cash position, they have the cash flow, they have the track record to continue creating great drugs, great treatments. And cancer, I think cancer is quite a big problem for us as we get older and older and older. We are very, very likely to experience cancer at some point or experience a tumor. You're never sure if it's a good or a bad tumor, but you're very likely to, if you get older, to get a tumor. And if it goes bad, then you want the right treatment. And I think the entire market is going to grow, so they are in a good market. And they have a right strategy, they have a good business, they have the right cash position to actually do the research to get the revenue generating medication. And on top of that, they also have share buybacks. So even if they don't go too fast, Last year, they bought back almost 2% of their shares, which is also very, very good. Now, if you look at their operational efficiency, gross margin of 95.42, that's absolutely massive. Operating margin of 31, net margin of 36. This is the best business so far that we've looked at from an operationally efficient perspective. And we have looked at software companies, and this has absolutely outperformed that. That's insane. The last return on invested capital was a little bit lower, no longer in the 20s, but in the high double digits. They don't have a dividend. Debt to equity is great. Again, cash to debt, it's being flagged as way too high, but for a biopharmaceutical, we can explain why it's high. Now, let's see. I think we have decided the company, this is a great business. Now let's look at the price perspective. Before we put in our numbers, let's look at the exit multiple that you're paying for the earnings, which is 12. This is relatively low, and I think biopharmaceutical companies are seen as a lot riskier, so most people are willing to pay a lot less for them. If there is another business that comes out, or another drug that has a better treatment or has a better efficacy than the drug that Genmab produces, your whole business model or your whole revenue driver is basically gone. Now, the chance of this happening is not zero, but for biopharmaceuticals, this can happen on a whim, or you can have a drug that's currently being researched in phase 3 and it can fail, and then you have invested a lot of cash into it. It's very cash intensive, and then you've basically thrown it all away. You need to acquire new cash, probably goes along with giving out more shares. The reason why I like this business, they already have other revenue driving medication, so I'm not too worried about them, at least for the short term. Now, revenue growth, let's say they continue to give it a 25, then we have 15, and then let's say they grow a little bit less. No, I think I want a little higher variance. Let's say they manage to grow 30%. Could they do that? How big is their income currently? Yeah, 21 billion. They're already quite big. So let's say I think 25 might be too high. Let's do it like this. And for this, I'm willing to pay 25, 20. No, let's not be too generous here. Let's be a little cautious. I do want 15% return. I'm putting the multiples a little lower, even at 20% is quite high. The market is also putting a lower multiple on it. So I'm being cautious and following what we see. And there is a massive upside. There's an absolutely massive upside. I think the price currently was around 30. Yeah, so we have a great business. We can buy it for a great price. And I think from a reliability perspective, drug trials are finicky, historically finicky. You never know if something is going to succeed, when it's going to succeed, and how well it's going to succeed, and how well it's going to do in the market. That's something that we will never be able to predict. So from a reliability perspective, that will always be an unknown. However, they can deal with that unknown because they have a very high cash position in relation to a very low debt position. This makes them very attractive. They also have a very steady cash flow that continues to increase. So they are already very operationally efficient, even if their new drugs fail. So to me, great business. If we sell Google, this is one of the top contenders to buy.